This month itself, we are seeing two of them, which is just opened. We do expect at least 3-4 more to happen before the end of the month itself. And more important than the numbers is just the quality of issuers that we see coming around. I think a point that Manisha mentioned about governance standards, about how the regulator has been proactive, has all ensured that the names that finally reach the marketplace are quality names. Governance standards are very high. Investors are extremely clear about what they want to invest in, what they don't want to invest in.
Absolutely.
That makes a big difference. For every IPO that happens, there are a couple of them which don't necessarily happen. The markets don't necessarily see that. That's because investors are selective. That's resulting also in correct pricing. And that's why 90% of the IPOs that have happened in the last in this current calendar year are all above water and doing well. I think the what has also helped the pipeline per se is the sheer amount of domestic capital available around the place, which to my mind is only getting stronger by the day. Manisha talked about the 50 crore, 100 crore IPOs. Yeah, we all started our careers when the book buildings in India started with a 100 crore size, and today 100 crore is not a size.
And the largest issue that you managed was 4,300 crores for Mankind Pharma.
In the current year, and prior to that, the LICs and the Paytms have been 18,000, 20,000 crore issues.
Absolutely.
And they have got done properly with Indian investors putting that in. One last statistic which is very important is there's a lot of dependency on FII investors in India in the past. If you take the current statistics of all the institutional book, an institutional book is split between domestic and foreign. There was a time when almost 75% of the institutional book used to be foreign. And so if one foreign investor decides to go away, the book looked weak. This time, across all IPOs, 60% of the institutional book is domestic. And therefore, the resilience of the markets is very strong. And domestic flows have been really very strong. So all in all, great pipeline, more importantly, good quality pipeline. And the underlyings are good. Businesses are doing well. So we do expect that, this kind of comfort around the marketplace will remain sustained for a bit.
Okay. Let's look at the retail angle to this. And we have Dheeraj Relly with us. He's a part of HDFC Securities, probably the brokerage with the largest retail reach when it comes to IPO applications. Dheeraj, to you, what has changed over the last 12 to 18 months? Do you see more IPOs being applied to online? In fact, I tried applying an IPO about 2 weeks ago, and unbelievably, the process has become so smooth. What has organically changed for providers such as you when it comes to applying for online IPOs, and what is the granular data telling you?
So, good afternoon, everyone. Thank you for having me here. I think the whole ecosystem has changed dramatically. It started with having more trust on the capital market ecosystem. That's the start point for retail participation. And that's where we see that there is a disproportionately higher comfort of investors, particularly retail investors, in the market ecosystem. They believe that it is quite robust. Then on top of it, I think technology have been a very big enabling point. Now you can do IPO with just one click.
Absolutely.
Okay. Most of the brokerage houses have an execution created in such a fashion that you just go and just with one click you can execute your IPO also. The third piece is that the awareness about the companies and their details through social media, through media players like you, I think that has also increase the participation. And right now the information arbitrage is very limited. Earlier the information arbitrage was very high. Institutional investors, whether it is FPI or domestic, were having an edge over information. But now through the social media platforms and brokerage houses or many other players, including media, the information is easily accessible to the retail investors. So it's not just the one piece. I think it's the whole ecosystem, the culmination of technology, regulatory framework, ease of doing investing, ease of doing business, the trust, all that has enabled a greater participation.
Right. So what we'll do, ladies and gentlemen, now, The young gentleman that you see seated 2 seats to my left is Pranav Haldia, and Prime Database, for all those of us who've been in the market for about 30 odd years, you would know that it's the pioneer when it comes to listing IPOs. Mr. Haldia, what a warm welcome to you. I just wanted to understand over the last decade or so, uh, what has changed for service providers such as yours when it comes to getting IPOs listed? I distinctly remember about 2 decades ago, we used to source data from Prime Database when it came to forthcoming IPOs. At the moment, this data is very easily available on all websites. So how do you differentiate yourself now?
Well, I think one biggest change from the 90s till now is just in terms of sheer numbers.
Absolutely.
So you had years in the early 90s where you had upwards of 1,000 IPOs in a year. Now we feel very happy if there are about 50. But at that time, there were 1,000, 1,200, 1,500 IPOs in a year, and a commensurate number of intermediaries to handle those IPOs as well. So the number of merchant bankers that you have, the number of brokers that you have, is a tiny fraction of what you had in the 90s. So I think that's been one big change. Of course, even in terms of the quality of companies which Salil spoke about, at that time you had a lot of fly-by-night operators as well. In fact, one of the ongoing arguments which I keep on hearing about is, if an IPO is a OFS IPO, then investors should not invest.
Yes.
But if it's a fresh capital IPO, they must invest. I keep on remembering the times of the 90s when all the IPOs were actually just fresh capital.
Yes.
In fact, they were absolutely greenfield companies which did not even have a manufacturing plant. Everything was on paper. And yet, and you saw that a lot of these companies ran away with investors' money. So they were all fresh capital, but they made for terrible investment.
You're talking about the 93, 95 IPO bull
That's
run
right.
that we saw.
That's right. That's right. So I think that's one major change which has happened. Talking more recently, I think one of the biggest changes that we've seen in this last 1 year has been in terms of the broad basing of sectors. In 2023, the kind of companies that you've seen from manufacturing, I think even in the previous session, they were speaking about the pickup of the manufacturing sector. So 2023, unlike the last 5, 6 years, wherein you've seen a lot of companies coming from BFSI, I think one big change in 23 has been the rise of manufacturing sectors as IPO companies. The other is also in terms of the size of the companies themselves.
Yes.
I think this year the average issue size was about 900 crores, which is down from about 2,000 crores 2 years back, which is a very interesting data point because it kind of says that slightly smaller companies, relatively smaller companies, also now have the confidence to come to the market. And since we are at a wealth creator summit, I think it ties on very well with that.
Right. Manisha, this one comes to you. When you look at how regularity we've changed when it comes to managing the legal part of the IPO, as also the fact that it used to take anywhere between 3 to 4 months for the IPO to get listed in the bull run that you talk about. Now it's less than a week, and probably it's going to narrow down further. What are the other regulatory changes that you're looking forward to that will make this particular market more robust?
So, if you speak to any of the global investors today across geographies, they say India is one of the markets which is the highest on corporate governance, regulation, etc. And the settlement point that you made is going to be transformative because I think that was, as Salil will tell you, that was a real blocker for a lot of investors because they didn't want to block their capital. Forget retail investors, institutional investors didn't have the mandate to block their capital for that kind of period. So I think the fact that we're able to settle much faster is a big positive. I think the fact that SEBI's mandate, SEBI has huge strict rules on how the board should be constituted, women on board, regulations on ESG, climate change, etc. All of these things basically show that we are very serious about ensuring that the companies are very high on corporate governance. Then also, as you know, in the last 10, 12 years, we've had private equity come in. The point that Pranav made, why is it that a 900 crore IPO happens now and previously it was 2,000? One of the key reasons is that because a lot of these companies have had private equity investors in them and have got used to the quarter-on-quarter treadmill, right? I mean, when you get listed every quarter, the investor expects to hear something new, wants full disclosure, and these companies today are already prepared. So with the combination of government regulation and external investors, the companies are very different from what they were 15 years ago, where it was just the promoter essentially.
Yes.
I mean, with one business plan, and those were the frothy markets. I don't think you can do that now. Firstly, your own investor base won't allow you to do that, and secondly, you're used to the level of governance that the market needs. So I remember when we used to do IPOs earlier, it was such a challenge because you pretty much had to change the entire management team. Literally, the munshi of the promoter used to be the CFO and say, "Yes, CFO," and you're like, "No, this cannot be the CFO. This is a serious. There are some serious disclosures."
And
Yes.
promoters are now more amenable to those changes.
Correct. Yeah, absolutely. Because that's the only way you can come to the IPO market. Accounting firms, all of that, everything, all of the different pieces. So it's not just regulation; it's the fact that all the different pieces have come together, which make the company far more easily IPO ready than it was a while ago, where we would take literally a year to get a company IPO ready. It used to be a business, just restructuring, advising companies for about a year.
Absolutely.
It's not the case now because a lot of the work has been done. To be fair, a lot of the promoters have second generation children who've gone and studied internationally, who understand the importance of governance. There's a lot more exposure. And even today, domestic investors are demanding, a lot more disclosure. So I think a combination of all these things has resulted in the companies that are coming through across sectors, right? Earlier, I remember the companies that we all used to like and we all used to go running to pitch for were basically export-oriented companies like pharma, IT services, because we were like, these are the companies which naturally have high governance. So, we would all steer to those companies. No longer the case. Across manufacturing, renewables, traditional companies, new age e-commerce tech companies, you're seeing a lot of governance driving these companies. So I'm quite optimistic on our regulatory and governance standards, and all my global clients tell me the same, that we should be proud of what we've done, and the small time that we've done it, thanks to technology and the digital public stack that we've created. I think the kind of way that we have instilled these changes and brought in new investors into the market is a record.
Okay. Salil, this question comes to you. When you talk to promoters, and I'm talking about, say, a decade ago, the big ticket or the aspirational thing used to be to get listed on the NASDAQ or the NYSE. Somehow, though, that particular trend is now more or less dead. And the preference is, of course, Indian equities, and this theme of OFS. I speak to so many retailers, I speak to so many brokers, and they tell us that, there's a bit of a question mark when a 2,500 crore IPO has 2,300 crores as an OFS. It seems that, the retailer is being taken for a ride. What does the promoter at that point of time think? Pricing an internet company which more or less sells automobiles on the net, being priced the way it is, and all of it being an OFS.
So first, let's take the myth out of the OFS being negative. Frankly, the OFS being a large component means that the company which is going to the market doesn't need the capital, and therefore it's not unnecessarily taking capital inside, which means that they've built a business out using either promoters' money or private equity money, built it, taken all the risks of building the business out, and once the business is well built, it's only when they're coming to the markets. So please, the market should look at it this way, that quality businesses, well built out, risk of building completely taken care of, and now it's ready for an IPO. There is a regulatory requirement that 10% needs to be diluted, and therefore a lot of companies have to do either a combination of fresh or a secondary. A lot of times the secondary comes into picture. Many a times this OFS is not only about the promoter selling. We do see a lot of private equity, who are the people who've taken the risk in building the business out, selling through the offer for sale route. And therefore money goes to private equity, which anyway has a limited amount of period, right? They're typically 5-year to 7-year funds, and they've taken the original risk, they're monetizing, they're returning back money to their LPs, and that money comes back into the markets because they fund newer businesses. So I actually think that the fact that built out businesses are hitting the markets is actually a big strong point.
Yes, and I think that's the dramatic change that has also happened over the last 2 decades. As Pranav was mentioning earlier, if you had an Excel sheet and you were able to get a DRHP done by SEBI, yes, you could sell that IPO and it would also get listed. But now it's the established companies, and perhaps your point on OFS is very well taken. Tata Technologies has done fantastically well.
Yeah, all of this. And the other thing about primary capital is, Pranav mentioned about people raising business primary capital on a business plan and disappearing. Today, SEBI is very clear about the monitoring mechanism. For every 100 rupees that you raise, the clear clarity on what you want to put it to. The end users has to be clear. Merchant bankers like us have to validate it. None of us will take the risk of validating something which we cannot validate. So we will ensure that only something which is completely kosher is out there. So therefore, no point in raising general purpose capital wherein there's no end use. So that's good news for market. I will actually look at it from every investor's point of view that the fact there's been a good quality set of private equity sitting inside means that there is a business plan which has got validated. There's a strong regulator which is ensuring that end use of money is monitored. Means again that it can't be misused in any way. Then it comes down to business growth risks, which is what equity markets is all about, and that's perfectly fine to take.
Okay. Dheeraj, this one comes to you since you have probably the best known digital platform in India when it comes to the financial banking part. How much of these IPOs are now being applied for online from the tier 2, tier 3 cities? We sit in Bombay, and there was a point of time that 50 to 70% of the IPO used to be filled by investors in and around 200 kilometers of Bombay. Has it changed now?
Dramatically. I think we are getting more and more investors to participate from not only tier 2, tier 3, I think even tier 4, tier 5 cities also. So, as I said earlier, the information, access to the information is easily available, and the risk appetite of the investors have also changed over a period of time. They have seen many cycles in last 2.5 decades or so. You know, there has been a dramatic change in their risk appetite. They understand that the fraction of their investment must go into the equity or equity related products to make optimum return on the portfolios. So for the new investors, there is a fancy for IPOs. They think that this is their way to participate in the
Yes.
capital market, particularly in many family accounts. Like when you have a 4 5 family members who are eligible to apply, they may not invest in secondary market in all 5 names, but when it comes to IPO, they think that this is the way they can participate, and that's where we see more inclusion when it comes to the number of unique investors participation in the capital market. So that is something which is driving the market. It used to be a phenomena in Gujarat particularly, or maybe Maharashtra, more dominated by these two states, but it is now well spread, and I think we are getting participation from such small pin codes and such small cities that it's difficult to fathom that how the information has reached to these places and how they are able to participate in the equity or IPOs.
I think you will have to thank the media for that. And
Yes, absolutely.
we'll pat ourselves.
And technology as well.
Absolutely. Technology has been the game changer when it comes to the entire financial space. And all of us on the table will recollect time when, the open outcry used to be in Bombay. And it used to be a great sight. But remember, everything was limited to Bombay when it came to retail as well as institutional participation. Pranav, we've talked in detail about the mainline IPOs, but it is the SME sector which is, the Wild West, so to say. This is the same theme that we discussed a bit earlier, the 93-95 bull run in the IPO market. Do you have any benchmarks or pain points when it comes to the boom that we are seeing in the SME IPO sector? Is it going to sort of continue for a while, or you see some kind of headroom being filled?
Well, so before I come to that question, I would just, like to add on to what Dheeraj had said. I think somehow this impression about IPOs to give positive gains until perpetuity
Yeah.
has been continuing from the, times of CCI. So still, what he said in terms of a lot of new investors coming in through the IPO route, that continues till date. And, most retail investors continue to come in from a listing gain point of view. And you find very few investors really coming in from a long-term perspective. So I think, that is something which kind of needs to change. Even the data that you alluded to at the beginning in terms of the number of IPOs which hit and how many are trading above issue price. The point is that at what point in time do we say that, do we judge the issue price of IPOs? Is it 6 months down the line? Is it 12 months down the line? Is it 1 year, 5 years? Because the day a company gets listed, it becomes like any other secondary market stock. And the share price will go up and down on the basis of the company's performance, the sector's performance, the market's overall performance. So, in my view, it's a bit unfair that we kind of expect IPOs to not just give positive returns on listing, but also until perpetuity, whatever that timeline be.
India is one of those countries where you hope to make money on a regular basis in the markets, and perhaps that is where that sentiment comes
Yes.
from. Till about 2 decades ago, IPOs were decently priced. This is not to say that investment bankers are to be blamed, or it's just the environment. The data that I give you, if we had this discussion about 10 months ago, it won't be as rosy as it is today.
Exactly, exactly. So it is at what point in time do you look at the data, and on that basis we make a statement on how good the issue price was. Anyhow, to answer your question about SMEs, yes, of course, 23 has been a stellar year in terms of SME IPOs. I think over 4,000 crores has been listed. My view is that, and you've seen some, action from SEBI, the regulator, as
Yes,
well, of late.
absolutely.
I think it's a bit of a mixed bag. There are, some high quality companies that you are seeing coming to the, SME segment. You also find that a lot of institutional participation has come in. If you look at the anchor book of some of the SME IPOs, it includes some of the world's largest hedge funds as well. So I think it's a bit of a mixed bag. Retail investors especially should approach with extreme care.
Absolutely.
I think it's also time that the threshold of 1 lakh, which was set in about 11 years back when the segment came up, needs to be looked at purely just from an inflation point of view. I think the minimum threshold for retail investors must go up, and it's buyers beware. The liquidity is very less. The trading is also very low, so I think investors need to be very careful while dabbling in these stocks.
Manisha, to you, any warning signs that you see from the SME sector? What should retailers, what should investors with basic amount of money to deploy in IPOs should look at when they put in money in an SME IPO?
So I think pretty much the basics, like what we were taught in the kindergarten of finance. Look at the DRHP, look at the financials, look at the balance sheet. There must be a path to profitability at the very least if there isn't profitability. Ideally, if you're a retail investor, go for sectors which are well researched and not something which is, just a new idea, something in the Gen AI space, which you don't, because not for any other reason, but we don't understand that there isn't enough of a track record. So I think go look at sectors. Most companies, and Salil will tell you this, will come and settle in the same valuation range as the other companies in that range after the initial euphoria. So try and go for sectors which are well researched. Please look at the balance sheet. Look at the bankers that are advising on the IPO. Right, high quality, reputed bankers should be putting their name to it. The accounting
Someone like
firm,
Access Capital to your right.
Absolutely, that's fine. I don't do IPOs anymore, so happy to. So I think that all of that is very important because, while I feel that a lot of the valuations are justified in the SME space because what the investor is seeing is that this is a 5 trillion economy going into a 10 trillion economy. And what they're seeing is that these companies with a lot of efficiency are going to grow very rapidly. But at the same time, some do slip in, right? In a frothy market like this, as you said earlier, there are some companies that can tend to slip in. And it's really important that we either, invest through SIPs if we don't understand the market, be patient around companies. And if you're investing directly, invest in companies after thoroughly reading the balance sheet, looking at the board of directors, the management team being good. When these boxes are ticked, only then go in.
Right. So we have 1 minute, 50 seconds left, and now comes the most important question, which I'll ask all panelists, starting with you, Salil, because you've managed the maximum number of IPOs here. What is the magic bullet to get a confirmed allotment in the IPOs that are in the pipeline? I have the answer, I'll tell you last.
Just look around for the nearest temple. Siddhivinayak is not too far.
Okay. Visit a temple, a church, or a masjid. That's what Salil says. Ma'am.
You know, my 85-year-old mom seems to get all the allocations, so I'll ask her and tell you because I haven't figured it out at all. But
Okay,
yeah.
okay. So since he's talked about mandirs, we'll also look at her astrological chart.
Yeah, blessings from the parents.
Absolutely. Pranav, you've been listing IPOs since 1980s. I'm sure you have an answer.
Well, apply in every single relative's name that you know of.
Okay.
That's one way. But, seriously, with the kind of oversubscription that you find, the chances of allotment are low. And even if you get an allotment, you only get one lot.
Kya
So
baat
it's,
hai?
Ajkal, to move the needle, it doesn't really do anything. One lot of allotment.
So I presume the three of us, the three of you haven't been as lucky as you have been in getting business from IPOs, right? Do you apply?
You're not allowed to apply. So.
Acha, chaliye. Okay, okay. Dheeraj, the last one comes to you.
I think investors should invest post IPO immediately after the IPO. That's a better way because if you look at some of the IPOs, how they have performed the post listing also,
Yeah.
carrying on what Pranav mentioned also, you should look at which are the good businesses and stay invested in those businesses. I think that's very important.
They get listed at 80% premium, but we'll take your word for it. At least you have
So
given
there
some
are
practical.
examples like Arida also, which is
Yeah.
after 32 rupees, now it's almost at 100 rupees
Absolutely.
in 10 trading sessions.
112. I'll just
Just
put in
to-
the right number.
Just to add
Salil wants
quickly,
to add.
Look at the anchor books
Yeah.
because the anchor books reflect the quality of names that have validated it and feel comfortable about it. The best of insurance companies, the best of mutual funds, when they participate, you know that somebody's done a lot of homework. Even if you do not get, stock in the IPO itself, these are the companies wherein there will be follow-on buying post-listing, and that's also, that's a time for a lot of investors to also get more, skin in the game at that point of time. Plan for the long haul. As Pranav said, there is no point
Absolutely.
judging a company on an everyday pricing basis. Plan for the long haul, invest in a good business, stay put for a long period of time. Wealth will get created by compounding and not by a,
Wonderful.
selling trigger on day one.
Okay, so don't wait for the listing pop, buy it on the listing day. And my final two bits, if everything fails, please come to Delhi. There is a Bengali Baba who actually assures allotment in IPOs. So I'm going to meet him, do a story on that one. That will be on Business Today Television. Ladies and gentlemen, a very warm applause for our panel.
Thank you, Shail, for that scintillating session. A huge round of applause, please. And especially for that tip right at the end of the session. All right, as we prepare for the next session on stage, let me give you a little bit of a heads up. We're going to be talking about something which is imperative in the current business and finance landscape, the 4 pillars of corporate governance. In the next session, we will delve into the foundational principles that uphold robust corporate governance, focusing on transparency, accountability, responsibility, and fairness. Can we please request everyone to settle down for the next session? Because we're ready. We're hoping you are as well. Thank you so much. Our speakers for the next session are G.N. Bajpai, former chairman at SEBI, Amit Tandon, founder and managing director, Institutional Investor Advisory Services, J.N. Gupta, co-founder and managing director, Stakeholders Empowerment Services. This session will be moderated by my colleague, Saurabh Majumdar, editor at Business Today. A huge round of applause, please.
Good afternoon. I doubt any of the BT500 companies, the people who are running those companies would be wondering who these three gentlemen are on the left of my, here on the left. Everybody who's anybody in the Indian corporate sector would be aware of who they are. To my left is Mr. Bajpai, who I know for what, Mr. Bajpai, about 3 decades now almost. Of course, Amit Tandon, and who's been a ratings expert and now runs his own, proxy advisory firm. And of course, the redoubtable Mr. J.N. Gupta, who has been in SEBI as well. And running investigations where the biggest companies used to be fearful of him. As I said, these are people who know what corporate governance is, and what a privilege to have all three of them here on this panel. So I will start with you, Mr. Bajpai, of course, of the seniority and the experience which you carry. The first question to you, and then I will go to Mr. Gupta, because both of you are from the market regulator. From your time at SEBI and now, what are the key 2 or 3 changes you see in the corporate governance standards in India today in the top companies which you follow or you know about?
Thank you, sir. Uh, since I have worked for SEBI, first there is a disclosure. According to my own definition, I'm a fossil. Because 5 years you become stale, next 5 years you become obsolete, and thereafter you become a fossil. You may ask me a question, then why am I here? There are some people whom you can't say no because they don't take no for an answer. Here is one, so don't bother about it. Now, SEBI has been focused on corporate governance significantly a long time. In fact, I had the honor and privilege of joining Security Exchange Board of India when the market was going through, I use the word called animated suspension because of a major market misconduct that had taken place. And there needed some kind of a wholesale reorientation of all market practices. And therein came the corporate governance. Before me, my predecessor had got Kumar Mangalam Birla Committee, which had brought about it. Then Narayan Murthy Committee was appointed, which brought in significant amount of improvement in disclosure, accounting standards, and the boardroom practices. Now, over a period of time, successive chairs and their teams have improved upon these, and eventually it has landed significantly on a very high standard on disclosures and accountability. Currently, if you have seen, and I would say the SEBI is probably ahead of the curve on other regulatory bodies having
The new beauty shopping experience. Tira, for every you. Download the app now.
new framework how the company should be evaluated. And in any case, as you are aware, the whole world is agog now. It's not only environment, but the social stability also. And also, corporate governance has itself turned to a different frame altogether.
Thank you, Mr. Bajpai. Mr. Gupta, you are now running a proxy advisory firm yourself, and you've been in SEBI. So what are the key changes? Because you keep a very close watch on corporate listed companies.
See, Saurav, you have asked a very difficult question, that what are the key changes? So there have been thousands changes that have happened in the last 20, 30 years. So the one change that you say that what is still yet to be done, is still to be effective, that change is implementation of everything, not in the letter, but in the spirit. So that is still a big vacuum. The second thing, as Mr. Vajpayee said, that lot of changes have happened in the governance improved. So I would say that all the effectiveness that is coming, it is not coming only because of me and Amit. We are one small part of this ecosystem. The biggest change that happened was the new Companies Act, where e-voting was permitted, where participation by investors was facilitated. Earlier, the meetings used to happen in Timbuktu or Jumri Talaiya, and nobody participated. Now with the e-voting, participation has increased. The second thing is this, taking cue from the Companies Act, SEBI came up with LODR, listing obligation, and that has impacted. Not only that, the impact of higher voting has happened in such a way that now the companies fear the risk of rejection. Now that fear is causing them to follow what me and Amit or other people say. You will not believe when we started in 2012, if we needed a clarification and call to the company, who SES what, and they will shut the phone down on us. Now they call us before the report what you are writing. So that significant change has happened. And again, I would say, repeat, the day the follow of the law is happening in the spirit, probably I would not be needed, because then people will be following it. And what I need to do, it's like this, that we always say that we are like a pathological lab. We analyze something and give you a report. Now, when you're so healthy, you don't need a pathology lab to give a report.
No, that's a very important point. Amit, I'll come to you from what Mr. Gupta said. The letter being followed, but not the spirit. Now, that's a very critical and a very fine line, right? Now, as proxy advisory firms and as somebody who knows the innards of companies because of your background also as a ratings person, how would you differentiate that, and what are the guardrails you think which shareholders, the minority shareholders who really depend on your protection in that sense, or rather your, flagging off the problems, how would you look at those?
So I'll kind of just supplement what Mr. Bajpai and Mr. Gupta said, and then I'll kind of go on to answer your question. So when we look at it, we kind of see the changes in three pillars. One of them, which both of them alluded to, was the change in regulations. They're a lot tighter. So if you look at the Companies Act, which Mr. Gupta spoke about, one of the fact ways is that you did have e-voting, but you also introduced majority of minority. Over a period of time, SEBI's come up with their LODR, tightened it. They had the listing agreement, which kind of gave way to LODR. So it's kind of a lot easier to bring in some regulatory changes. And that has been kind of done by way of what are special resolutions, what are ordinary resolutions. And they're important because both of them have a different threshold at which resolutions get approved. With the ordinary, it's 50%. With the special, it's a higher threshold, so you need 75%. And therefore, there are a constant set of changes. The Kota committee came in, which kind of had its own recommendations. Mr. Gupta and I were both members of it, and one of the focus areas was that, look, there are some gatekeepers, which are the auditors and the independent directors, and therefore they should have a greater role and responsibility. So I'd say at one level, it has been the regulations. The second is, what is important is in this whole period, the ownership pattern of companies has also changed. And that needs a bit of emphasis, because if you go back and you look at the market, I'm looking at it in terms of market cap rather than the absolute number. If you go back to just before the financial crisis, the Indian promoters held about 60% of the equity and the institutions held about 20%. So for every 3 shares which was held by the promoter, 1 share was held by an institutional investor. Today that ratio is 35% with the institutional shareholders, 50% with the promoters. And therefore, it's 1.5:1 or 1:1.5, depending on how you're measuring it. So that equation has changed. So the institutional shareholders have started sitting on the high table, so to speak.
And do you think, just to add to what you're saying, do you think institutional shareholders are also becoming much more involved?
Yes, they're much more involved. And I'll just come to that. But you know what that 35% means, and the size of the market, which was alluded to in the earlier session, is that you've got investors with deep pockets. So earlier, when we started, an investor held 1.5% equity. So the promoters would say we can ignore them. Now you've got people with 8.5, 10% equity. So it's not so easy to ignore. So that has also become a large part. So the whole fact that the institutional framework has changed, and they're much, much more involved now. So I remember when we started, you did not have e-voting. We went, I remember we'd gone with an investor to a shareholder meeting where it was show of hands. And all resolutions got defeated through show of hands. What happened next day? What was filed was that all resolutions got approved. There was nothing you could do. Now with e-voting, each vote is getting counted. Not just that, the institutional investors are much more engaged. And that actually goes hand in hand with what is called stewardship. Stewardship is the fact that institutions don't own, it's not their money, they're managing money for their unit holders or policy holders, and therefore they have a responsibility. And you find that that is also a part of the regulatory changes, is that stewardship codes have been rolled out. So that has meant that investors are much more engaged. So when we started off, soon after we looked at it, 82% of the resolutions were abstained, 18% were voted. Now, 82% are voted, 18% shareholders are abstained. Coming back to what is it that institutional investors should look at, the opening comment I would say is that there's a general improvement all along. But I what in focus on is, who are the other investors? The more institutional investors you have, the better you would expect the governance quality to be. They also need to focus a little bit in terms of what the systems and processes are and what the company's communications are. Those which communicate more and better tend to be better governed because they have better grips with their of what is happening. And those who are poorly governed, don't communicate that much. And sorry, I know I've spoken for a long, long time, but I'll just kind of walk everyone through a fairly interesting study which we've been doing pretty much since 2012. We look at companies and the timing of their AGMs. We find that those who have their AGMs in June perform, or June and July, have better financial performance than those in August. Those in August have better performance than those in September. And if you're a loss-making company, you're more likely to have it in the last week of September than before. Back to you.
That was a very interesting insights. We'll come to that. Mr. Bajpai, you have been the regulator, and then you have also been independent directors. You have sat on boards. Now, tell me, I mean, the one thing we need to discuss at this forum also is the role of independent directors, including in the current scenario where a lot of, in that sense, problems or misdemeanors can be countered by the independent directors if they really become more firm. Do you think at this point that independent directors are really doing the responsibility, fulfilling the responsibility they have been assigned?
So you'll have to give me some space to be able to come back to really answer this question. We are asking for the role of independent director into a very narrow concept. First and foremost, I was one of those initial votaries of the fact that the firm is not owned by the shareholders alone. The Friedman doctrine, which was created in early, the great Milton Friedman, that a firm belongs to only shareholders and its responsibility is masters, only shareholder. That has subsequently been, as late as 2019, 183 the US Roundtable have accepted our stakeholders. Now, this is the first part of it. The second part, which is very important to understand, is that firms are not a charitable organization or NGOs. They are a commercial entity. And if they are a commercial entity, their purpose or their impact of their functioning should be different. The third and most important aspect is, and then I'll come back to replying to your question. The third and most important aspect of the function is that in an efficient market hypothesis, where the resources are limited, they should be allocated to one who can create the wealth optimally. True. Now you put all these context into the frame of asking what independent directors do. Well, I'm afraid, even, and I'm sure you won't mind,
please,
I like to criticize media on on their face in this, in the presence of the.
We are used to it.
Okay.
Don't worry.
See, you have in fact been appreciating or understanding or criticizing the performance of a company from a narrow aspect, whether disclosures were adequate or not, whether accounting standards were followed or not, whether some minor, even without verification, some of the independent directors are consigned to media trial much before even anything is proved about it. But point I'm making is that first and foremost it has to be understood that independent directors represent more importantly the other stakeholders and then the shareholders alone. There are too many people to take care of the shareholders. Total shareholders return. There is so many analysts and so many people keep on doing. But what happens to other stakeholders? And that is where, and I mean, I can say that because I myself probably couldn't succeed, that the boardroom practices, what actually happens to the boardroom, hasn't significantly improved. It's not only a question of independent directors. Yeah, you're right. Independent directors have a role. But wherever I said, I felt I am an independent director not only for the minority shareholders, majority in any case take care of themselves, but also for the human resources, but also for the state, but also for the society, and but also for the customers.
So that
Now,
is where media,
that is
has,
where
been,
the, that
media
is
has been asking questions about these exact things, that how independent, first of all, are independent directors in many cases. So it is not that media has not asked.
You have asked, but then let me tell you what exactly I have been watching the boardroom issues are. There's a risk blindness. There is inadequate or you say inappropriate compensation. There is no accountability for any other stakeholders than the shareholders alone. And I would like you to kindly consider. And thirdly, which is more important, and right now it is being discussed everywhere, is the environment,
Yes.
is the social stability. Now, these are the questions which have to be asked by independent directors on the board. But since the entire, now of course, as I said, SAB has moved ahead of the curve by laying down the 6 principles, which are also, unfortunately, what happens, as Mr. Gupta was saying, yes, in filing the information, in trying to see that their performance on disclosure is better, accounting standards better, I would like to ask myself a question as an independent director. Why do I reckon only an accounting profit? What about the economic profit of the firm? If the resources of the society are limited, there has to be an accounting, both by the independent directors and non-independent directors, what happens to the economic profit of the company?
Mr. Gupta, taking off from the very important points Mr. Bajpai and you yourself also have made earlier, I want to ask you, I mean, in talking about the letter and the spirit which you raised, again, the role of independent directors may be, questioned on that count as well. How do you as a proxy advisory firm, and we will then come to the role of proxy advisory firms as well, how do proxy advisory firms like yours then view the role of independent directors? Are you really looking into each and every one of them, how independent they are, what are the kind of cross purposes they work at, and all of that, the entire gamut of issues?
So the problem with you is that you ask a question with 100 questions underlined there.
Because we are short on time, na?
Okay, so I will go one by one. The first is this: I feel that independent director is only for the purpose of appointment as an independent director. Once he is appointed as independent director, he amalgamates in the entire board as one of the directors. Because if I carry in the boardroom that I am different from 3 other gentlemen in the room, I become a different class. The moment I become a different class, there is either going to be adversity or feeling of superiority or feeling of inferiority. So I would say the class of independent director should cease the moment I am on the board. That is for the purpose of appointment. Secondly, even when I am not an independent director, I should be putting my mind as an independent person for analyzing the resolution that are brought or the discussion should happen. Unfortunately, what has happened, it is seen that independence mean opposition. The moment I have a contrary opinion that you, I am independent of you. That is a very dangerous thing to say. The problem that again happens, I, as a proxy advisor, I have no view what happens in the board. I don't know who spoke what or who speak what, I don't know. So it is extremely difficult, or rather foolish of me, to pinpoint a director that you have not performed or something like this. It is not. Having said that, what is our role is to say that what I, as a shareholder in ordinary course, would react when I see what is written in the notice or what is the agenda item. In the conference theme, you have written the 4 pillars of governance. I say there is no 4 pillars. There is only one pillar, that is fairness. Fairness encompasses everything that is there, the transparency and all the thing in the fairness. The issue is every director should examine the issue that is being discussed or proposed for the shareholder. Does it satisfy my fairness standard? Only one thing is to be remembered. If I was on other side, how I would take it. If I am satisfied that what you are throwing to me is a good food, I will take it. But if you are not ready to eat that food, you can't feed it to your guest.
True. Mr. Bajpai, I know you are passionate about ESG, and you mentioned this in the beginning also. Now, the SEBI has been trying to move towards, getting companies to comply more and more on the ESG front with BRSR and now BRSR core. But recent studies have found only 27% of Indian companies are really, prepared for ESG. How do you view that? I mean, because now it is
Assembly to know what exactly is the challenge now. Ladies and gentlemen, I'm sure you all must be reading the twin revolution of industrial revolution and innovation of joint stock company with limited liability, common seal, perpetual succession, etc., enhanced and speeded up the economic development of the world. Millions of people, because of these two inventions, have been brought out of the poverty. But also, incidentally, because there was no checks, this has led to the annihilation of the environment and also social inequity. Now, and since you asked the question, let me link it once again, Saurabh. You certainly have a reason to ask an independent director, what did you do? How did you perform? But first, please help us to change the context of that person's role itself. Right now, you are asking whether all disclosures have been done. He will say yes. All accounting standards have been followed. Yes. But we haven't really still defined who the stakeholders are and whether they are contractual stakeholders or the residual stakeholders. Because residual stakeholder get from the residual. And then if he has to get something from the residual, how can you have only total shareholders fund? It will be stakeholders fund. So all I'm coming back is that environment has become very, very important. And let me give you some data. I'm sure all of you have been reading that we are already more than 1.5 centigrade above the industrial times. If nothing seriously is done, I don't seem to be. A lot of glib talk. I'm sure you have known what happened in Dubai today, the compromise that is reached. By end of this century, will be 3.5 centigrade above, and by middle of next century, 4.5. And this will lead to just a simple loss of 5 trillion annually to the economy of the world. But if you take the loss of productivity, etc., 40 trillion is going to the loss. I'm giving you this data because this must be brought to the focus by the media that the environment in the corporate governance is not just a fad. It's a very, very serious issue which has to address immediately.
But companies aren't able to conform.
That's what I'm saying. Now comes the question. I mean, I'm sure you were HUL. I mean, not HUL. The original company has been accused. I'm using the word deliberately accused. Still not confirmed that they have been doing greenwashing because broad standards have not been developed. And which is what is important for all of us today is to get really serious with the scientists and develop one, level two. I mean, I'm sure you are aware, they've already been definition by the scientists. Level one is what you pollute. Level two is what the services that you take. Level three is the one who buys your product and what kind of pollution he creates. Now, unless you have a reckoning for regulations, also talk of only level one. And rightly so, because we don't have those standards available. So my suggestion to you and including to the regulators is, now let's get serious. Because, I mean, why Dubai, no compromise could be reached? Because all the petroleum companies were up against us.
True. We are running out of time, Amit. The final word. What are the 2 or 3 things you would like now Indian listed companies to do? Of course, one of them clearly is the ESG front, which Mr. Vajpayee referred to. What are the things you think is the unfinished agenda in terms of compliance on the governance front from somebody who's tracking these companies so carefully?
I think it's much more on the regulation side, and that's something which was alluded to, which is that companies don't actually seem to pay the consequences of not adhering to regulations. And that is, if you kind of look at Indian regulations, they kind of match with the in the world. And in some instances, I would say globally, they're catching up with where our regulations are. How, with regard to enforcement, we should be at this time. And the one consequence of that, in which people, you kind of then bring in another regulation because one is not being complied with. That's not the solution. The solution is pick up those who have not complied and have punitive damages so that there is much more adherence to that. So I would say that is the big unfinished agenda.
So the regulator must act tough and there should be consequences for not adhering to it. Mr. Gupta, I have many more questions, unfortunately, but we have run out of time. But if you, yes,
give
please.
one word. See, my interaction with many people, whether the company, whether the investor says, they have a concept that compliance is a cost. And this mindset had to change. How many of us say that medical insurance is a cost? Medical insurance is a necessity. Similarly, treat compliance at the final word.
On that note, I think it's absolutely fabulous discussion. We could go on and on. Thank you very much, gentlemen. Yes, yes, please.
Because there is an assembly of the representatives of people from BT500. May I request you, ladies and gentlemen, don't look at corporate governance hereafter from the narrow prism of only enhancing the shareholder value. Please look for corporate governance from environment protection, from social stability, and economic value add that you do out of the resources that you use.
Last word from the regulator. Really well put. Thank you very much, gentlemen. And a warm round of applause for them.